Stocks broadly lower. Well, US stocks pretty level now, and Nasdaq hanging in. Earlier, we did see a little bit of selling after President Trump turned up the dial in his trade war. Let's bring in Dec Mullarkey, Managing Director of Investment Strategy and Asset Allocation at SLC Management. Dec, thanks very much. Look at the equity markets first, if you would. In fact, earlier we saw some selling, and we have seen the steel stocks jumping, the domestic steel stocks, but the markets generally don't seem too worried about Trump's latest escalation.
Good morning, Andrew. Great to be with you. You're absolutely right. They seem to have somewhat faded some of these threats, and that's been kind of an evolution that's been happening for a while. In some respects, you would say, well, maybe that's just acceptance of the expectation that some of the things, there's always this maximalist ask, and then it's going to get dialed back. So I think some of that is kicking in here. Mm-hmm. The one thing, though, we have to be careful about, though, is that if markets get too complacent and assume that there's not going to be this feedback, which has helped. When markets kind of riot a little, the White House unequivocally has dialed back. But you're right, we are seeing a fairly tame reaction here, and probably with the expectation that this is the opening salvo, and there'll be some negotiation, and maybe this will settle at a tamer spot.
Looking out a bit longer, you see economic disruption, possible impact on corporate profits right from the trade war, right through this year into next year before consumers and companies adapt?
That's right. That's right. I mean, the expectation is these tariffs are going to start hitting at some level, and that's, of course, that's to be determined. But it usually takes companies, and for that matter, consumers, like 1 to 2 quarters. So let's say on average 6 months to absorb this, to figure out, particularly for companies, to rejig how they can order the supply chain to kind of maximize the outcomes and see what they can pass through in prices. And the same thing on the consumer end. They'll go through this period of substitution, figuring out where their budgets are, kind of settling in and making sure they're secure in their job. So our expectation is that where you would have kind of normal growth in a year of 2%, both in the U.S. and Canada, you're probably going to have half of that, and probably half of that for next year. But the main reason that we expect that towards the end of this year and into next year, you're going to see that fallow period where everybody's going to be pulling back, trying to reorder, trying to rejig and reset for the next stage of growth. So that's why we see 2 kind of quarters or to 3 quarters of like really disappointing growth. But then you get back on track once you settle into 2027. And the effects of the tariffs are then fully reflected, and you have base effects, and then year over year, inflation is back to normal. So that's kind of the path we see this playing out along.
On the bonds, now I said before the break that the bond vigilantes were on Washington's case, but I slightly understated that. You think that there are concerns about big deficits in many developed countries?
No, you're absolutely right, and the U.S. unequivocally is one of those. Japan is getting picked on right now. It's interesting, that term I think was coined by Ed Yardeni back in the 90s to say, hey, they're the force that's really going to remind you when you're getting out of step. But we see that happening right now, particularly Japan, the U.S., the U.K. as part of that. You see a little bit in France. Although 30-year yields are up in Germany, it's for a different reason. They're expanding. But you see what's happening in Japan, that investors are just pushing back. They do not want to buy the long debt. And as a result of that, Japan has had to say, OK, we're going to issue at the short end. And your top story one of your top stories this morning is playing off that and saying it's coming to the U.S. that, they mentioned big players like PIMCO and DoubleLine, that they're expressing the same concern, that they prefer not to buy at the long end, that they see more of an opportunity at the short end, like the 2 to 10, because I think that 30-year rates, which are much more responsive to fiscal discipline or the lack thereof, and that's why we're seeing pressure on those going up, is that investors aren't certain where all this is land, and they want to send a message right now that we want to see more fiscal discipline. So that's happening. So it'll be interesting to see how Washington, responds here, even through this week, with some of that pushback.
That's interesting, yeah. So it's apparently a buyer strike hitting the U.S. long bond market, people like PIMCO staying away, and some players are even shorting these long-term 30-year bonds in America.
But that's right, because their view, of course, as yields go up, prices come down. So shorting them, you can gain from that. So you will see that trade probably start to come to the fore here, be it hedge funds or even more traditional managers. And that comment I think you were picking up on there, that came from a very traditional manager, although aggressive in terms of capturing total return. So that's where we are. We're in this new phase where fiscal responsibility is being demanded, and a lot of people call this a revival of a Liz Truss moment, which is reference to last year or a couple of years ago rather in the UK, where they put a budget out there that made no sense. The bond market really responded and revolted, and Liz Truss had to resign. So they're not shy about showing when they get impatient here, and I think we're going to see more and more of this.
The Liz Truss moment, yeah. That's really, it's all history really remembers about her. Unfortunate that way. Anyway, Dec, we'd better go. Thank you very much indeed.
Great, thank you.
Dec Mullarkey, Managing Director of Investment Strategy and Asset Allocation at SLC Management.